Hello, I welcome you to this YouTube channel. My name is Dr. Obafemi Oyiwumi. I really want to appreciate the fact that you are online right now watching this particular lecture. Today we're looking at taxation and management of it. That's talking about taxation theory and management. And the topic before us today is tax assessment and filing of tax returns. Tax assessment and filing of tax returns. If you're yet to subscribe to this channel, please do just that. And I want to appreciate those that already subscribed. I'm not taking this for granted. Thank you for joining once again. Let me share my screen so that we can continue the lecture for this particular moment. Okay, I believe that we are seeing it right now. Let me put it in presentation mode. They can see it clearly. Okay, just a minute. It's coming up now. All right, here we are. Okay, here we are. So we're looking at taxation theory and management of taxation, basically tax assessment and filing of tax return. Tax assessment, what are we talking about? Tax assessment is the act of determining the tax liability that a taxable person must pay. That is what tax assessment is all about. It is the act of determining the tax liability that every taxpayer must pay per time, whether it's a corporate entity or an individual. Tax assessment is basically the same thing. It's the act of determining what the amount to be paid as tax liability. Now, according to FIRS, self-assessment is a method whereby a taxpayer is required to correctly compute his tax liability, properly complete the tax returns, pay the self-assessed tax, and submit the tax returns together with accompanying documents on or before the due date according to the relevant tax laws. So that's what self-assessment is all about. The responsibility has been shifted and given to a taxpayer to, on their own, compute accurately, correctly his own tax liability. Nobody's doing it for him or her right now, or the entity. Okay, and also the responsibility is also given to him to complete the tax returns and of course pay the self-assessed as you are the one assessing yourself. So you have to pay by yourself and of course submit the relevant documents to the tax authorities. So assessment is also a system that have been okayed as a matter of fact that has been entrenched in the Constitution of Federal Republic of Nigeria, and it said that it's a duty of every citizen to declare his income honestly to appropriate and lawful agencies and pay his tax promptly. Okay, Section 55, subsection 1 of CITA. CITA means Companies Income Tax Act. Okay, as amended, requires that the company should file a self-assessment tax return with the service in the prescribed form at least once a year, and such returns should include the company's audited accounts, tax and capital allowance compensations for the year of assessment, a true and correct statement in writing containing the amount of profit from every source computed, a duly completed self-assessment form, and evidence of payment of the whole and part of the tax due to a designated bank for the collection of companies' income tax. So that's all about self-assessment. So the constitution guarantees that you do it. Relevant laws also prescribe that it must be done by every company. You must self-assess yourself when it comes to tax, returns, talking about the amount you're going to be paying to the relevant, tax authorities. So that's self-assessment. So let's still continue and talk about self-assessment, the more. Self-assessment payment method was introduced when? It was introduced in 1992. Following the enactment of the appropriate law in 1991, the law was appropriated, came up in 1991, all right, and then in 1992 it was introduced. But of course, the self-assessment regime did not start fully until 1998. That was when it became mandatory for every person, whether an individual or a corporate organization, to self-assess, itself or themselves. Okay, so before 1998, it was the duty of tax authority to assess the taxpayer to tax, and taxpayer must pay the tax liability within the specific time limit, okay, or exercise the right of objection. All right, so, but after 1998, the role has been shifted Okay, a paradigm shift took place whereby an individual or a corporate organization, will come up with their own liability that they've assessed to say that this is the amount that I'm owing, okay, and then the amount that I'm owing, and of course, the amount I'm going to pay to the relevant government agency. So the Nigerian tax self-assessment system requires that the taxpayer accurately calculates his tax liability, file self-assessment return on or before the statutory date, pay the tax due at the designated bank or online to collect the e-ticket, and the tax authorities accept tax returns as filed, subject to the simple on-the-spot checks to ensure that tax return forms are correctly, completed. Okay, so let's look at the advantages of self-assessment, system. Self-assessment is more cost-effective as it reduces the cost of collection of taxes. That's number one. Number two, taxpayers are allowed to pay taxes in three equal installments over 3 months. Okay, they choose to do that. Where all installments are paid on due date, 1% or 2% bonuses, okay, are deductible from future tax of large and medium companies, respectively. So that means that when you pay your taxes assessed by yourself 90 days before the due date, you are entitled to 1% or 2%, bonus, as the case may be, for large and medium tax, companies, respectively. So it gives you an advantage to take advantage of. It gives you an advantage as a taxpayer to take, to take 2% or 1%, as the case may be. It gives the taxpayer a sense of belonging. It gives the taxpayer a sense of belonging, such as tax evasion, and as a result, tax evasion. This is supposed to be evasion, please. Evasion is reduced. Tax evasion is reduced. Self-assessment encourages early and timely settlement, okay, collection of taxes, and then self-assessment reduces corruption by reducing contact with taxpayers. So it means that you are the one assessing yourself, you are the one going to the bank to pay, so you don't need to have any interaction basically with any taxpayer. That's what tax planners today has encouraged. You assess yourself, online, and then you pay the respective tax that you've done. You assess yourself too, and then you take all the the needed document and take to tax authorities. Okay, that's what self-assessment is all about. Okay, those are the advantages that we gain when we talk about tax self-assessment. Okay, let's look at limitations. Illiteracy of taxpayers. Self-assessment demands knowledge of the tax system and arithmetic competence, which some business owners may not have. And that's true. That's the truth of the matter. Some business owners are not that literate or not computer savvy to be able to know how to actually feed their forms online. They don't have the requisite knowledge. And so it may limit the effectiveness of self-assessment. Number two, low level of tax morale in Nigeria. In most cases, thank God that today, yes, a lot of improvements have been made over time, but if people are used to the norm of people of the tax authorities coming to them to remind them, to visit them, to remind them, and of course, maybe to enforce tax payment. But of course, today, if care is not taken, there's every tendency that some taxpayers probably just forget about the fact that they have to file their tax returns, as appropriate. They could also be subjective, because taxpayers may not be sincere in their own assessment. Self-assessment is done by the taxpayer himself. So they may not be objective, they may not be objective as much as possible as when somebody is looking at, whatever it is that they are doing, part time. So it's also prone to errors on the part of taxpayers. So let's look at filing of tax returns. Filing of tax returns. A taxpayer is expected to file returns every year, stating all sources of income, as well as the computation of taxable income and tax payable. That's the norm. That's what is expected. Every year, every taxpayer is expected to file tax returns, okay, with the attendant computation of taxable income and tax payable. For each year of assessment, a taxable person shall file a return of income in the prescribed form containing the prescribed information with the tax authorities of the state. Filing annual returns ensures that a business complies with with the requirements of tax laws. It also ensures that a company gets a tax clearance certificate, which is a requirement for government contract bidding in Nigeria. And of course, failure to file, returns will attract some penalties. And this, of course, could pose a lot of challenges to government, to corporate organizations, especially as regards their future, when you have to now pay for penalty. Penalties are not tax deductible. So it means that when you pay, you're suffering for it. So it is important that every tax, payer ensure that they file their returns as at when due. Financial statements accompany the returns for companies that have started operations, and the statement of affairs accompanies the returns of the companies that are yet to commence operation. So what's saying that if a company has been in operation, then you're expected to file. You're supposed to, in the process of filing, you're supposed to include, the relevant financial statements, to your filing. Okay, and then if you are just starting, then you are also expected, to include your statement of affairs. Make sure that it accompanies your tax, returns that you are filing. Okay, once the company has prepared its returns, if the returns include financial statements, it then assesses itself by preparing the tax computation based on the operating result of the financial statement for the year. On the other hand, if the return is a statement of affairs, the company does not need to prepare tax computation. So if a company has just commenced business, or rather he has not commenced business, that means that yes, we need for him to file what is called statement of affairs. But of course, by the coming of Finance Act 2019, it's no longer required that the company should file statement of affairs. So that means that a company is not expected to file any result until it starts operating its business. Okay, so returns to file depend on the type and nature of the tax. Returns to file depends largely on the type and the nature of the tax. In whatever case, the company logs into Tax Promos, which is the online platform for filing returns with the FIRS, files and then generates a document information number. That talks about DIN, okay, which is numeric code used to pay any tax due or due taxes arising from filing. Let's look at companies' income tax. Companies' income tax. We're not looking at specific taxes now to be filed. Okay, let's look at companies' income tax. Section 55 to 60 of CETA covers the submission of returns to the tax authority. So all existing companies should file their tax returns 6 months, not later than 6 months after the year end. After the year end, not later than 6 months. Anything beyond 6 months will attract, relevant penalties. Okay, a newly incorporated companies is to file CIT, that's company's contact, within 18 months from the date of incorporation, and not later than 6 months after the end of the accounting, period. The documents required to be completed or filed by the taxpayers, okay, include the following: number one, audited financial statements, tax computation for the relevant year of assessment, showing income tax computation, capital allowances computed, schedule of non-current assets, the taxable income, tax payable, evidence of payment of the income tax liability, partly or in full. Let's look at the penalty. Penalties for not filing CIT is written there is as follows: 25,000 naira for the first month and 5,000 for each subsequent month of default. So the moment you fail to file after 6 months, 25,000 for the first month and then 5,000, subsequently. Okay, late payment of CIT will attract 10% penalty and interest at commercial rate. Then let's look at education tax returns. This is another return that is also important for every company to file. Okay, education tax. That we've covered this particular aspect, sometimes by talking about the types of taxes. Okay, the due date of filing education tax return is the same as that of CIT. So it means that as we are filing for CIT 6 months, latest 6 months after the end of the year, it means that you must also file your education tax returns. Okay, as provided by Section 11 of the Third Fund Establishment Act. Okay, First offense against this act is liable to, upon the conviction, to a fine of 1 million or a term of 6 months imprisonment, or both. Second and subsequent offenses attract a fine of 2 million or a term of 12 months, or both. You can see the penalties. So it means that as a taxpayer, you must file your CIT as at when due. You must also file your education tax accordingly as well, in order to prevent you paying unnecessary penalties. Okay, let's look at petroleum tax. Petroleum tax. So estimated tax returns for each accounting period are to be submitted not later than 2 months before, not later than 2 months after the commencement of the accounting period. So for PIT, it's different. You are not to wait until the end of the year. You pay concurrently. So 2 months after the commencement of the accounting year, it's expected that you have to file your estimated tax return with the relevant authorities. Okay, final returns for each accounting year shall be filed within 5 months after the expiration of the accounting period. As provided under Section 51 of the Act, penalty for late submission of a return will attract an initial 10 million naira and further sum of 2 million naira for every day that the failure continues. So it's expected that even for PIT, you must file accordingly so that you don't fall prey to all these unnecessary charges that will come. Any installment of tax not paid on due date shall attract a penalty of 5% and interest at the prevailing minimum discount rate of CPN. If payment is not made within 1 month, enforcement shall take place. As for PIT, let's talk about pay as you earn. Pay as you earn. Pay as you earn is a scheme that involves every staff that is working or has been employed by every organization, by any organization. So it is expected that they pay their own income tax. The company would withdraw the deduct from their salary and then remit to relevant state internal revenue internal revenue board or service, okay, as the case may be. Okay, so this is a scheme in which personal income taxes are deducted from salaries and wages of the employee by the employer and remitted to the relevant tax authority. The due date of remittance is the 10th day of each month, 10th of each month. I mean, the subsequent month. So once the month ends now, within the next 10 days of the following month, it's expected that the remittance should be made to the relevant state government. This time around it goes to the state government. Okay, that's why I use the word state internal revenue service, not inland revenue service, state internal revenue service. So direct assessment. This is a scheme that applies to self-employed individuals. The self-employed individuals will, without force or notice, demand or without notice or demand, file a return of income earned in the preceding year and pay the requisite PIT. Okay, that's personal income tax to the relevant tax authority. So if you are a self-employed person, any self-employed person is expected to file their own returns to the relevant state internal revenue service as well. It's expected to do that. And that is done 3 months into the new year. 3 months to the new year. That's when it is usually done. A penalty of 500,000 will be liable to be paid for any corporate organization that fails to do his own remittance. I mean, file his own return, and then 50,000 in case of individual employer. So that's therefore pay as you earn. Let's look at value added tax. No, we are looking at the different taxes to be paid to the government, and the times to file, and then the remittance to make, and of course the penalty in the event of a default. Section 15 of Value Added Tax Amendment Act 2007 provides that taxable persons are required to file VAT returns every month, no later than 21st day following the month of transaction. So every taxable person is expected to file for VAT not later than 21st day of the following month. So government ministries, departments and agencies, oil and gas companies play a dual role as taxpayers and as agents of VAT collection. So it means that these agencies, they are enabled, empowered, not just to pay their own VAT, but also to withhold VAT on behalf of the government. So if you have any contract with any of these agencies, ministries, departments, and agencies, while you charge VAT, while you charge them VAT, they will not remit the VAT to you, unlike other organizations. They will not remit the VAT to you. They will withhold the VAT that you have also, then they also withhold your withholding tax, and then they will now remit to the relevant, tax agencies. That's what this particular place is telling us. Okay, under VAT Amendment Act 2007, both government agencies and oil and gas companies are empowered to withhold VAT as source and remit same to FRS accordingly. Okay, the banks and telecommunications companies are now allowed to also withhold VAT as source as per Finance Act 2023. Okay, let's look at the penalties now here. Okay, failure to file VAT returns will attract 50,000 in the first month of failure and 25,000 for each subsequent month. The default continues. That's as per Finance Act 2020. So a failure to file VAT returns will attract 50,000 the first month and then 25,000 for each subsequent month. That the default, continues. So that's for a value added. So let's go to withholding tax. Withholding tax is in Nigeria is a form of advance payment of income tax. It is a payment on account of the ultimate income tax liability of the taxpayer or company. What we're saying here is that withholding tax is not a new tax. It's just payment in advance. So if you carry out a particular responsibility or you carry a particular service to a company, that company is at liberty, is empowered to deduct a portion of the money that is supposed to pay to you. So that money will be paid as withholding tax. That tax is enabling you to pay tax in advance. Enabling you to pay tax in advance. So what it means that once the company pays the tax, it gives you a receipt to show that that tax has been paid. So when you are filing your own tax returns, okay, when the company is now filing its own tax returns, the receipt collected from the company that deducted withholding tax will now be removed from the total tax liability, and then it is the net that particular tax that suffered withholding tax will now have to pay. Okay, so withholding tax is normally deducted at source when payment is to be made to the beneficiary. So at the point of payment, withholding tax will be deducted. And the law governing and regulating payment of withholding tax is Company Income Tax Act and Personal Income Tax Act as well. Okay, so this is the last part of it, saying that penalty. The due date for filing of withholding tax is 21st day of each succeeding month and 38th day of the following month of deduction for, that's when it has to do with state. Okay, individuals will pay withholding tax to the state, while corporate organizations, limited liability companies, public limited liability companies will have to pay their own to FIRS. Okay, the penalty for late filing of returns is 25,000 for the first month and 5,000 for each subsequent month of that failure continues. Penalty, okay, for failure to deduct or remit is 10% of the amount not deducted or remitted. So that is bringing us to the end of this particular session, this particular class. I believe that you have enjoyed. I believe that you have learned one or two things concerning tax, the filing of tax returns, and of course tax assessment, and by extension the method of tax assessment that we're talking about today, self-assessment. All right, and I believe that you have been able to learn a lot, and you can say more, as much as possible relating to this. So if you have enjoyed and if you have learned one or two things, I would like to subscribe to my YouTube channel as well. I want to say thank you for watching. Till we see again, or till I post anything relating to taxation. Bye for now. Thank you.